American stock markets have enjoyed a stellar return in the past year. But some experts worry that the bull run that has sent U.S. shares to record highs could come crashing down. Savers who invested at the start of the shares boom in 2009 have pocketed spectacular returns. In those 9 years, a £10,000 investment in the S&P 500 has turned into £49,200. However, rising interest rates, expensive U.S. stocks and the emergence of a new technology bubble are potential threats to savers' money. So is it time to cash in and ditch the U.S.? Experts are divided. Just last month, Bank of America warned the bull run would come to an abrupt halt in the second half of 2018. Since then, however, President Donald Trump has managed to persuade Congress to pass $1.5 trillion of tax cuts, which could prolong the run, some experts say. The measures are expected to boost economic output to between 3% and 4%, which could act as a catalyst for the stock market to grow even further. However, at the same time, looming interest rate rises could act as a ballast for the economy, experts warn. The Federal Reserve has increased rates twice in 2017 to 1.5%, the highest they have been since the financial crisis, and has said there could be at least 3 more increases next year. Rising interest rates usually spell bad news for stock markets, as consumers and businesses are forced to pay more to borrow money, and therefore have less money to spend. But the increases are likely to be small, which should provide some comfort to investors. Jason Hollins, of advisor Tilney, says, "A lot of people say rising interest rates are not supportive of the stock market. But what you have got to bear in mind is rates will still be relatively low, meaning there will still be an abundant amount of cheap borrowing out there. Possibly a bigger threat to the stock market is the bubble forming in the technology sector. Silicon Valley giants Apple, Microsoft, and Amazon are now the 3 largest companies in the world by market capitalization. Their rapid growth has also been a key driver of the U.S. stock market over the past decade. Now experts are beginning to worry that many technology stocks are priced too high compared to what they earn. He adds, "None of us have crystal balls, but it would probably be wise to be cautious and reassess your portfolio." For savers keen to pull money out of the U.S., he recommends looking at Europe and Japan. Bolte & Holland's tip Jupiter European, which has turned £10,000 into £21,837 in just 5 years. It has big holdings in budget airline Ryanair and Novo Nordisk, the Danish healthcare giant. If investing in Japan interests you, Caliph tips Schroeder Tokyo, which has turned £10,000 into £21,820. Some of its biggest holdings include Toyota, one of the world's biggest car manufacturers, and Japan Airlines.